And we begin our talk of the tape. That rip-roaring rally, as Sarah just mentioned, to end Wall Street's first positive week of the month of June. Stocks finishing at session highs with monster gains across the board. The Nasdaq gaining more than 3% on the session. The S&P, by the way, having its best day since early May, and then adding more than 6% on the week. So did this week's rally signal a possible bottom for the markets overall, or is this just a bear market rally, and is there more pain ahead? Let's bring in now Anastasia Amoroso. She's the iCapital Chief Investment Strategist. I mean, we've been talking so much now for the last several days and maybe a couple weeks now about a bottoming process. It is a process. We know It's not just one point in time. Do you feel, though, as though this is constructive at all? Do you feel more comfortable with the way the markets are reacting?
You know, I do feel more constructive and more comfortable. And the reason for that is, Dom, we've done a ton of work in the first half of the year. And what I mean by that, in terms of resetting expectations, we came into the year thinking there's going to be 3 rate hikes, and instead we're going to get to 3.4% by the end of the year. That's a massive adjustment that had to happen, and it had to trickle in and be priced into a variety of valuations. You look at the valuation of the Nasdaq, the S&P 500. We've seen meaningful resets in those. We've seen a bunch of froth come out of a lot of different sectors. So because of that, Dom, I do feel more constructive that maybe as difficult as the first half has been, the second half is not going to be quite as treacherous because probably there's not as much downside that's left to go. You know, is this the absolute bottom? Is this it? I can't quite make the call at this point because there's one thing that I still think has to happen. We've reset the valuations, but we have not reset the earnings. And the earnings, in the event of a recession or even in the event of the slowdown, they probably still need to come down. 6% in a slowdown, 13% in a recession. So we might still have a little bit more work to do.
Okay, so that's the one thing. A lot of folks out there talk about this idea that the recession and the earnings picture could be what the biggest factor, I guess, in the market valuations going forward. You have to tame the inflation picture first, right? And the Fed talking, the pundits out there, even the Fed policymakers themselves have said that you have to see signs of inflation markedly coming down before they're going to even think about slowing that pace of interest rate hikes. So it's not chicken or egg. We know it's interest rates and we know it's the inflation picture. Are there signs in your mind that that inflation picture is starting to calm down?
I think there are signs, Dom, and I think something very interesting happened this week. So first of all, I would say if you look at the CPI number versus the core CPI, core inflation is actually starting to come down. I mean, it's not plummeting, but it's definitely edging down. But it's the headline inflation that is so persistent, and that's why the Fed reacted so strongly to it, because the consumers don't care about the core. They care about gasoline prices, they care about food prices, and that's what drives inflation expectations. But you know one way you can talk down inflation? You start talking up the probability of a recession. And that's exactly what Fed Chair Powell has been doing. So him openly acknowledging that we might be going for a recession, in a way, actually acts as a way to bring down some of the inflationary pressures. I think Jim Cramer said this earlier this week, but you look at the price of wheat, you look at the price of oil, they have come down significantly. And guess what? That feeds into expectations.
So here's the thing. 9 months ago, we knew that the inflationary picture was at play. But we didn't hear that R word, recession, nearly as much as we do right now. We've made the point before that the hard economic data, the stuff that you can count, things like GDP, CPI, PPI, are all oftentimes backward-looking. Meanwhile, the forward-looking soft economic data, CEO surveys, polls, all of those things say that we got consumer sentiment at the lowest level in 4 decades. Are we going to talk ourselves into a recession?
Yes, that is a question that I hear asked a lot, and I feel like we kind of are doing that right now. But in a way, maybe that's exactly what the Fed wants, because one of my themes for the second half of the year is it's return to rational activity and return to prudence. And if you think about what's been going on for the last 2 years, it's been disruptions all over the place. It's been revenge spending. It's been traveling as much as you can. It's been hiring as much as you can. That's not rational activity. That's not prudence. But I think what's likely to happen in the second half of the year, we're going to retrench. We're going to return to some sort of prudence. And if that's happening because we're now talking ourselves into a recession and want to be more conservative about it, that's actually a good thing from the inflation perspective.
So is that your base case? That kind of return to more fundamental thought, that more kind of rational thinking with regard to investing? And if so, have enough of these growth-oriented technology-type communications media stocks come down enough to become rational in your mind? Or is this still going to be one of those things where you say, hey, it's going to be those defensive, less economically sensitive consumer staples, utilities, healthcare type plays that really do the heavy lifting in the second half?
Yeah, I think it pays to be a contrarian investor. And if you look at the valuation spectrum right now, all the defensive stocks are bid up quite a lot. They've rallied. Their valuations have extended. They're in the top 75th percentile over the last 5 years. But you look at the flip side of that. And if you look at something like growth software stocks, for example, you look at parts of healthcare, you look at biotech, they've beaten up significantly. So I think that's the rotation opportunity. And I've been talking about this earlier in the year, that it's not the time to chase cyclicals because the Fed wants to slow down cyclical activity. But when we come out on the other side of this, the valuation on growth has reset so much. And by the way, growth is secular. It's not going away. So I do actually think that's where investors want to be stepping in. And case in point, this week, the big outperformer of this year, energy, has corrected a lot. But what investors have been nibbling on are those growth software stocks.